Today's class, we'll be talking about the cost of capital. Class, we'll be looking at so many practical illustration on cost of capital. At the end of this class, you should be able to solve. There's one 15 marks question for last day. I think 20 marks to 15 marks question under the cost of capital. You should be able to solve that question right at as much as 4 pages under the cost of capital, because we will break it down to the what, to the barest minimum that you will, in fact, you will understand the concept very well, right? Now, the question is, what is cost of capital? People have been saying, what cost of capital, cost of capital. What is cost of capital, class? Cost of capital is like a sources of finance. Don't forget that what bring about the cost of capital is from the sources of finance. Don't forget that when a company want to finance a business, right? When a function of a financial manager, investment function, the financing function, and the dividend function. Under the financing function, that is when we talk about the what? That is when we talk about the sources of finance. Now, the cost of capital is the sources of finance, right? Which is among the function of a what? Of a financial manager, right? Which is what? To source for fund. Now, as a financial manager, look yourself as a financial manager or as a CFO of a company who want to invest in, who want to embark on a project, right? Definitely, you will consider the sources of finance. Now, this will now take us to what? The cost of capital. Of course, when you want to finance a project, you will need money, you will need finance, it will cost the firm, right? So that is why cost of capital now came in as a result of what? Investment. You want to finance a project, you need to consider some. How will you finance it? Are you going by equity or you are going by debt? Right? Now, what is cost of capital? Cost of capital is the minimum required return that investors are expecting from their investment, class. Now, there are two phases to cost of capital. I said is the minimum return that investors are expecting from their investment, right? Right? Investors are expecting what? From their what? From their investment. Now, what I'm saying is that there are two phases to that. Who are these investors that are expecting from something from their investment? Right? The shareholder, you buy Jitco Bank shares now at the rate of 2 naira per shares, right? You as an investor, you are expecting something from you are expecting it. It is not an obligation that Jitco, for instance, will pay you even if they don't make a profit. It is not an obligation. It is what you are expecting from your what? From your investment, right? Now, what you are expecting from your investment could be share price growth or capital appreciation, or it could be dividend. Because you now, as an investor, as a shareholder, right, you buy shares, you are expecting either capital appreciation from your investment or dividend. Now, a rational investor will think, oh, capital appreciation is not profitable. Capital appreciation means that there is an increase in the share price. You buy a share at the rate of 2 naira per share. Now, in the next 2 months, it increased to 10 naira per share. So there is an increase of how many percent? 80%. So that means that there is capital appreciation. Some investors will look at capital appreciation, right? Go for capital appreciation. Why some investor will go for dividend? Dividend is paid usually at the end of the year, but for aggressive investors are investors that always want return on their investment. They are waiting for dividend, right? But they don't want to wait till the end of the year. That is why we have what you call interim dividend. This interim dividend is that before the end of the year, they will pay you probably every quarter or the first quarter. Yes, they may pay you like 3 naira. No, it is not normally up to 3 naira, maybe 0 naira 25 kobo, right? 0 naira 25 kobo. So you so that you relax, right? That means that is sending a signal to the investor that, oh, this company knows what they are doing, omo, if they can be able to pay me 0 naira 25 kobo in the first quarter, omo, I have to invest more. Is a signaling. This will take us to dividend policy, but we are not there now. Now, you are sending a signal that. So, what bring about this is because I said investors are expecting two things. Either you say share price growth, or you talk about what dividend. You talk about what dividend. Now, that is the minimum required expecting. That is the expectation. It is not an obligation, class. It is not an obligation. It is only debt that is it is not an obligation that the company must pay you even when they did not make profit, class. Now, I said there are two phases in that definition. I didn't complete it, right? Now, I said it's a minimum return that investors are expecting from their investments, right? And I only that definition just cover shareholder. Shareholder. What about the debt holder? Because cost of capital is divided into two. You talk about the equity and you talk about debt. Now, the continuation of the definition is that if the investors are expecting dividend, a minimum return. If they are expecting something from their investment, why it is what? Requiring the what? The firm, the company to pay the holder, the debt holder, as at the day what? As at the date of what? Maturity. You can see the differences, right? You can see the what? The differences that the first one is they are expecting. Why the second definition? Why the debt holder? Why it is requiring the debt holder, right? To do what? To receive their payments, right? At the date of maturity. It is requiring the company to pay at the date of the what? At the date of the maturity, right? Because there is an obligation. This will take us to one of the factors that affect dividend policy. For those who have paid for the material, I will try and forward the dividend policy. I've worked on that dividend policy very well. See, now that is one of the factors that affect dividend policy because you must pay your you must pay your debt holder before your what? Equity holder. This will not still take us to conflict of interest between the shareholder as well as what? The debt holder. You can see that CFM is interesting. It will just understand. You see, once you understand, you can write, you can explain, you can do anything in CFM. It's just for you to understand the concept. Now, class, are we still together, please? Let me confirm. Are we still together? Or I'm just talking since. Are we still
Yes, we
together?
are together.
Yes, yes.
Yes, sir.
Okay. That's fine. That's fine. Good. That's fine. That's fine. So now, that's okay. Victoria, do you have question? Okay, just wait. Just wait. If you have anything, just wait. You can just make use of the chat button, please. Now, okay. Now, I've explained the definition of cost of capital that it is what shareholder, the shareholder is expecting from their investment is the minimum return that shareholders are expecting from their investment. While it is requiring the company to pay the debt holder at the date of the maturity. With that, it has covered two things, which means the equity holder as well as the what? The debt holder. Plus, now don't forget what bring about cost of capital is the sources of finance. You want to invest now. for instance, a capital investment, right? You are considering either you go by equity or debt. That is as a financial manager, because it's a function of a financial manager to do the analysis of the sources of what, or of the sources of finance, right? Now, the costs of capital, class, the cost of capital, it is the cost to the firm, right? Because you want to finance a project, you don't have money, and people subscribe to it. I will give you an instance why it is a cost to the firm. For instance, during CBN recapitalization policy, right? You see, so many banks are coming up with right issues, bonus issue, right? Now, with that, people will subscribe to it, right? Now, if people subscribe to it, it is the cost to the firm, right? It is the cost to the firm, because it is not a must you must pay them, but the shareholders, the investors rather, the investors will be expecting that, oh, for instance, so for the purpose of this discussion, for instance, oh, GT will pay them well. GT with the expectation that, oh, I will go for share price or capital appreciation. No, I will go for share price. The other person will say, I will go for dividend. That is small. This will not still take us to what we call we have different what is it called? Oh, we have different investors view, right? Now, that. It is the cost to the firm, because if you don't pay, if the investors are not getting anything at the end of the day, they buy the right issue. You know, right issue is the sources of finance. You say, oh, below right issue is usually in the a price below the market price. Below the market price means that you go to the NGS or you go to the London Stock Exchange, and let's say NGS, the market price is 2 naira per shares, right? The market price is 2 naira per shares, and they say, oh, we want to do a right issue of 1 naira per shares. You can see that it is below the what? The market price. Is that also? It's a sources of finance to the what? To the company, which means that it is a cost to the firm. It is a return to the investors, because you as an investor, you will be expecting something from your what? From your investment, right? Now, if that is established that it is the cost to the firm, the cost of equity, it is the cost to the firm. Even the cost of debt, of borrowing, it is a cost to the firm, while it is the return to the what? To the debt holder, right? To the lender. Now, it's the same thing as the same thing as equity. It is a cost to the firm. It is a return to you. It is a return to you, because you will know that, Omo, I have money in what? In JIT school, right? I'm expecting something for my investment. You are, because as an investor of equity, you are expecting it, right? Now, if this is established, now, cost of capital from the definition is divided into two, right? Where we have the cost of equity and the cost of debt. Now, question may like, oh, because at the end of this class tonight, you should be able to go and check that past question, that November last diet, and you use your understanding of this class to solve that question and send to my DM. Now, there are two differences between the equity and the what? And the what? When you are comparing the cost of equity as well as the cost of debt. Now, who can give me the differences between them? When you want to compare these two together, how will you compare them? Right? Or we say the characteristics of both the cost of equity as well as what? As well as debt. Now, let me quickly move. Now, during liquidation, like we want to liquidate, we don't want to exist again. For instance, let's say for a company that don't want to exist again, the cost of debt, the debt holder are the first people to be paid. See, a question of 5 marks or 10 marks could be that, tell us the characteristics of equity and debt, or you compare both equity and debt together. Class, during liquidation, you need to pay the debt holder before the equity holder. Do you know why? Because there is an obligation that you must pay them their interest and their principal at the date of what? Maturity. It is why one of the fact that affect dividend policy, right? That affect the dividend policy is what we call covenant, right? Oaths that, oh, you fill a form and you say, oh, you will pay them, right? And if you end up not paying them, there is a problem. You need to settle them before the equity holder, right? Another characteristic is that the cost of equity is always higher than the cost of debt. Do you know why? Because equity holder are the risk taker. They are the guys that are expecting something from their investments, right? Equity holder are risk taker, right? That is why it is always higher than the cost of debt. Now, why is it the cost of debt? Because of the tax relief on the debt. Because at the end of the day, we are talking about the cost to the firm, the interest being paid, right? The interest being paid, there will be a tax relief on that interest being paid, right? You will now see that the cost of equity will be higher because an equity holder is taking a risk to invest in what? In shares, right? Is that also why a debt holder will just sit down, we make an agreement, at the end of the date of majority, you pay me both my interest and what? Principal, right? And both the interest and what? And principal. Now, another thing we should as well look at, I think I've talked about what is it called? During liquidation, they are the first people to be paid. So another thing is that they have the right, them so that have the right, to receive their interest as and what? And payment. The interest and payment as and what? As and what? As and when due, right? Why equity holder are expecting dividend, either dividend or capital appreciation. Once I mention at the end of SFM class, a whole SFM class, right? You should be able to tell yourself that now I am an investor or a financial or an investment analyst, that you can do an analysis on something, right? When people are talking about something, you could say, oh, this is how it works, even in practice, right? Now, and this is the comparison between the cost of equity as well as cost of debt, because 5 marks question may come from this, that you should analyze the differences between the cost of equity and what, as well as what, the cost of debt, right? Class, are we still together? Let me confirm that. Are we still together?
Yes,
Together
sir.
we are.
Hey,
Together we are, sir.
okay.
Yes, we are
Just
together,
give
sir.
me, please, just few seconds. I'll be right back. Few seconds, please. Few seconds. So that is why at Next Gen Professional Associate, we don't lecture, we teach you what is applicable, what you will use to pass your exam, as well as the knowledge that you will use in your places of work, right? Now, after if this is established, right, how do we determine the cost of equity? We'll first of all pick it from the equity part of it. We'll pick it from the equity. When we are done with the equity, we move to what? The cost of debt, right? Now, class. Now, there are two methods of calculating the cost of equity. There are two methods of calculating the what? The cost of equity. Now, what are these methods? Even in practice, you calculate the cost of equity, right? when you are doing valuation of a business, right? We'll get there. Now, the method of calculating cost of equity is divided into two, right? I would have added one, but I remove it, which is the Modigliani and Miller assumption, right? Now, the first method is using the dividend valuation method. Now, you can agree with me that there are some company that they are they let me say there are some company that don't pay dividend. If you check, go and check, you can check my post on the link on LinkedIn that I've I wrote something on company that pay dividend and company that does not pay dividend, right? Now, when you want to calculate the cost of equity for a company, you need to watch, is it dividend paying company or not dividend paying company before you will now decide the method you will use for calculating your cost of equity, right? Now, there's no point of you using the dividend valuation method, whether with growth or without growth, when the company is not paying dividend. So how will you establish that, right? Where will you get your information, right? Now, the CAPM is another method of what calculating what cost of equity, which means that under the cost of equity, there are two methods: the dividend valuation method as well as the what the capital asset pricing model. We'll pick it from the dividend valuation method, right? Dividend valuation method of calculating cost of equity. There are two methods under the dividend valuation method, right? One, the dividend, with growth, as well as what you can see the dividend valuation model of estimating the cost of repetition. Now, there's dividend with growth, right? And there's dividend without what? Growth. Class, are we still together? There's dividend with growth and there's dividend without what? There's dividend without growth, right? Are we still together? There's different dividend with growth and without what? Without growth. Now, under the dividend valuation method, if you want to look at dividend without growth, dividend without growth means that a company will pay the same dividend till perpetuity. You pay, if you are paying 2 naira now for 2024 financial year, right? For 2024 financial year, it means that in 2025, you will still pay 2 naira per shares. Do we have such company in Nigeria? If we have that kind of company, nobody, investor will not go for that kind of company. Like, I took a risk to invest. You now pay me that, oh, it's 2 naira, oh, it will not even increase the dividend. Go and check the dividend paid by the Gitco Bank at the end of their financial year of 2023. 2022 will be different for 2023. That is, there is a growth in what? In dividend. Now, this is dividend without growth, right? This is what dividend without growth, which means that when you want to calculate the cost of equity using the dividend without growth means that an investor will receive a constant dividend till perpetuity. So what is the formula? Now, in every Ican question, it will be clearly stated that, oh, using the dividend valuation method, using the capital asset pricing model, determine the cost of equity, right? Determine the cost of what? Determine the cost of what? Equity. Now, under the dividend valuation method, you will be the one to like say, oh, you'll be the one to check for it if it is constant dividend or there is a growth in dividend. Now, without growth means that they will just pay one fee, right? From till date. Now, what is the formula for calculating that? What is the formula? Now, the formula is KE, you can see it. Please confirm if you can see my screen, right?
Yes.
I can see you.
You can see it.
Okay,
Yes, we can see.
okay. Good. Now, the cost of equity is equals to D1 divided by the MV, which is the market value S interest. Now, SD, sorry. Now, you can see that KE is the cost of equity. D1 is the current dividend, right? D1 is the what? Is the current what? Is the current dividend? Current dividend, sorry. Okay, current dividend, right? YMV. MV is what? Is the market value SDIV class. It is, some will say it is market value, it is market price SDIV, and some will say, oh, it is market value SDIV. Anyone. Now, the question is, what is the SDIV there? SDIV. Now, in every question, there is CUMDIV as well as what? SDIV. Now, when a market price, when they say, oh, the dividend is yet to be paid, if they say the dividend is yet to be paid, right? Which means that your market price given in that question, it is cum div. When a dividend is yet to be paid, it is called cum div. Cum div means that we have not deduct, from the market price, we have not deduct the dividend. Now, do you know why? Because the market price shows the value of equity, shows the value that what investors will receive in the future, in the future. Now, if they say dividend is yet to be paid, right? It means that it is what? It is cum div. Please take note. Cum div means that dividend is yet to be paid, right? Why SDIV? If the question says that, oh, the dividend has been paid, right? You could say, oh, this is what? The market price or the market value is what? Is SDIV. Now, in a question, excuse me, in a question whereby they say dividend is yet to be paid, how will you now determine? And your formula that you will use, you need to use, and the formula that you need to use is D1 divided by market value S interest. But they are telling you in the question that it is yet to be paid. So the question is, how will you now determine the market value SDIV, right? Now, I think I didn't put it here. So determine the market value SDIV, right? The market value SDIV, right, is equals to the nominal price of the shares, minus the outstanding dividend. We give you your market value or market price SDIV. That is when in a question they mention that, oh, the dividend is yet to be paid, which is cum div. Cum div means that the dividend is yet to be paid. Is that not so? Now, and you need to get market value SD, because from the formula, it has market value SD. What you need to do is that check for the nominal price. The price of the shares is the price being stated, being placed on the shares. When we get to bond valuation, which one of our partner will take that, you will see where he will mention that, oh, the nominal price of a bond is, even a bond have a nominal price, right? All right. And that is how it works. Now, having explained this, right, we will move to, this is the dividend without growth, right? That how to calculate the cost of equity using the dividend valuation without growth. Without growth means that they will just give you one dividend. If you see the equation, they give you only one dividend and you will not given a series of dividend, that means that, oh, the dividend is here, is constant. For you to calculate the cost of equity using the dividend valuation method, you use the dividend without what? Growth. Now, another method under the dividend valuation method is the dividend with growth. Excuse me. Now, the dividend with growth, right? The dividend with growth means that what is it called? And investors will not receive a constant dividend. There will be it is assumed that investors' dividend will change, right, in the foreseeable future, which means that if I receive a dividend of 2 naira per shares in 2022, what I will receive in 2023 could be 4 naira, right? It is assumed, right? Which means that it's the company that will do the projection that, oh, we will give investors in 2023, we will give them this. Or when you want to, most times, right, the investment analyst guys, what they do is that they would have you would have checked either investors relation or NGS to check for a company dividend in the last 5 years, right? Or investing.com. So you will have checked from there. From there, you will now extract your information that, oh, this is the dividend that has been paid because it's historical, right? Now, dividend valuation model with growth means that investors will take will receive different dividend, right? In the what? In the future. And what is the formula for calculating the cost of equity using the what? The dividend with growth, right? Now, when you are given a series of dividend in a question, which this means that the dividend, there is a growth in dividend. And the question will now say, oh, calculate the cost of equity calculate the cost of equity of AA Nigeria Limited without even telling you should use either dividend valuation method or capital asset pricing model. The next thing you need to check is from your question, when you're given a series of dividend, yes, oh, there is a series, which means that I'm to use the dividend valuation model with what? With growth. Now, you can see the formula as D1, 1 plus G, right? Now, the 1 plus G there means that the D1 is the current dividend. The current dividend means that, oh, this is the current dividend, right? And 1 plus G, that is the growth rate in the future, right? The D1 does not include the future, it's the current dividend, right? Then if you want to grow it, that is when you will have 1 plus G, right? Divided by the market value SDIV. I've established that in my formula that, okay, market value SDIV is calculated as the nominal share price minus the what? Outstanding dividend is the dividend that is yet to be paid. The current dividend that is being mentioned that what? It is what? It is yet to be paid. Class, are we still together? Are
Yes,
we still
yes.
together? Okay,
Yes.
okay, that's fine. So when you divide your D1, open bracket 1 plus G
Yes, sir.
divided by the market
We're still
value
together.
SDIV, right? Divided by the market value SDIV, your answer you say plus the growth rate. Now the question is that the growth rate will not be given in the question. The growth rate you have to you will be the one to determine the growth rate, right? Now, how will you now determine the growth rate? There are two methods again, class. Don't forget how we start. Let me quickly do something of a recap. We started with the cost of equity. That there are two methods of calculating cost of equity: the dividend valuation method, the capital asset pricing model, right? Now, under the dividend valuation method, there are two methods: the dividend with growth, without growth, and the dividend with growth. We have established the dividend without growth, right? Now, the dividend with what? With growth, right? Now, another thing is that how do we calculate, well, what is it called? The growth rate, because the growth rate will not be given, right? Now, another thing is that the methods of calculating growth rates, there are what? There are two methods of calculating growth rate. Class, are we still together? Uh, are we still together? There are two
Yes, we are
We
methods
are
of
together.
what?
We
together.
are together.
Yes,
Okay,
sir.
thank you. Thank you, thank you,
No,
thank you,
sir, we
thank
are not
you.
together.
We are not together. Okay, they play. They play. Now, now, um, the person that said we are not together, immediately after this explanation, probably you have question, right? So you can ask your question. Now, the method of calculating growth rates, there are two methods of calculating growth rates, right? You need to use either extrapolation of historical growth or you use the Gordon's growth model, right? Now, extrapolation means that you are using the extrapolation first. Now, another name for extrapolation could be geometric mean. That is why under the objective of the financial manager, the question that we solve, that they say, oh, using the arithmetic mean as well as geometric mean, right? As well as what? The geometric mean. This is where it comes from, right? Under the extrapolation of what? Historical growth. Now, how will you now determine your growth rate? Using extrapolation. Extrapolation, when you are given a series of dividend, don't forget, if it is dividend valuation with growth, you are given a series of dividend, you should know that, oh, this is, oh, and they say calculate the cost of equity. Oh, there is a growth. You need to calculate the growth rate using extrapolation. Now, extrapolation is calculated as what? The growth rate under the extrapolation is calculated as what? N minus 1, right? The current dividend divided by the what? Earliest dividend minus 1. Now, let me explain this. The current dividend from this illustration here. Now, the current dividend is 20 kobo. Is that not so? The earliest or the earliest dividend is 2021. The earliest dividend is the years you are looking at, right? So the earliest dividend is what? Is 2021, which is what? 2 kobo, right? So this divided by this minus 2, the n is the numbers of years, the n minus 1. Now, class, who can answer this question? If you answer this question, if you are here to get your material, the cost of the material is 2,000, right? Then if I want to ask a question now, if you get it right, I'll give you the material free, right? Now, who can answer this question? Now, who can give me the reason why you have n minus 1? Let's say, for instance, look at it now. The numbers of years is how many years? 3 years, right? 3 years. And you say 3 minus 1. Why do you minus that 1? Why do you minus? Because for every formula, you should be able to know the reason why. Oh, Victoria.
Yes, sir. It is n minus one because in the case of where they gave us a dividend for 3 years now, the dividend has only grown two times. Like they are, for example, 2010, 2011, and 2012. Now the dividend has grown from what it was in 2010 to 2011. That's the first growth, and from 2011 to 2012, that's the second growth. So the growth is actually two times, not for the 3 years. There was a two times growth.
You try. Well done. Well done. Okay. Okay. Christy, are you on this call? Please take notes of, okay, Victoria. Okay, Victoria. Okay, Victoria. Well done. Well done,
So what is the
Victoria.
question again?
Okay, the question is that why do we
Can I
have
try it,
n
sir?
minus 1? Yeah. Damilola. Damilola.
Okay, okay. Okay, I thought somebody's asking a question. Or can I talk?
No, just talk. Right.
All right. You said the question, if I get it correctly, that why do we minus one from the number of years?
Thank you.
Okay, it's just like commencement. If a business commence now,
Yes.
we can't know the valuation till
Yes, I
another
said, what
accounting
is the
year.
question? What is the question again?
The question is, why are we minusing one from the n in the formula for extrapolation? Hello, can everybody hear me?
Go ahead, please. Go ahead.
Okay, like it's just like commencement. A business can, even if it is asset or whatever, it cannot be revalued until another year entirely. Just like if a business starts today, just like this 2021, 2022, 2023, there is no valuation before that time. So before we can know if it has increased, the dividend has increased, we will get to know in 2022. And at 2022, we will get to know at 2023. So that's why we are.
And Damilola.
Sir?
Yeah, well done, well done. That's good. That's good. Well done, well done. Well done, well done. Don't worry, I will send the material. Just send it to me on WhatsApp, as well as
Yay!
as well as Victoria, right? Victoria, right?
Thank you,
The two of
sir.
you should send me. So
Yes,
both of
sir.
you have a free
Thank you,
gift.
sir.
Yeah, free gift. Well done, well done. Yeah, well done. That's a very good one. So that is just the simple reasoning, right? We in what is it called? In SFM is just every formula have meaning, right? So n minus one means that in 2023 there is no growth yet until we move. For instance, now a company that started business here in 2025 there is no growth yet until we get to 2026, right? Before you will know that, oh, there is a growth in this what in this company. So that is why they normally minus one from this, right? And that is the extrapolation when there is a series of what of dividend. When there is a series of dividend, you should know that, oh, there is a growth here. Now, the question is that how will you now determine the growth rate? Is to use extrapolation or the Gordon's growth model. Extrapolation, your series of dividend. Now, let's quickly look at the Gordon's model, right? What is this Gordon's model? Now, the Gordon's models here it makes use of what? The accounting profit, right? For you to get your growth rate, it makes use of what? The accounting profit, right? Now, the question is that what is the formula for calculating the growth rate, right? The growth rate is calculated as using the Gordon's growth model. It's calculated as what? G equals to R times B. You can see R times B here, right? Don't forget that Gordon's growth model makes use of accounting profit. I will tell you why it makes use of accounting profit, right? I will tell you from the formula, right? That is where I derived my. Okay, Titilayo. Titilayo.
Good evening.
Yeah, good evening.
Okay, so my question is this: the last
Please,
class we
hello. Okay. Sorry about that. Please, maybe when I'm done with this Gordon's growth model, you can ask your question. Do you get? Hello, Titi. Okay. Now,
formula you gave us was Gordon's.
okay. That formula is for Gordon's, right? I
Yes,
said
that
it's
we
for
used
Gordon's.
to do the analysis of that first question you gave.
Yeah. You can just change it to extrapolation. Sorry, it was an omission then. You can just change it. So there is no problem. Even if you did not write Gordon's or this thing, just put what they say you should do, put the formulas and move on. Right? That is most important thing. Most important thing is for you to get what they say you should do. I think it was actually an oversight then, right?
Okay, so the former one, we should change the Gordon's to extrapolation.
Extrapolation, exactly. Now, class, let me quickly explain that here. In that analysis that I did, I said equivalent annual growth rate. Equivalent annual growth rate, and now open brackets, Gordon's growth model. So instead of putting that Gordon's growth model, it's supposed to be extrapolation. Because if you want to use Gordon's growth model, this is the formula for calculating the Gordon's growth model. So you can see that the analysis that I did, the analysis in that last class goes with the extrapolation, right? You can see that it goes with extrapolation when we have n minus 1, the current return divided by the earliest return minus 1. So the error there is that I wrote Gordon's model instead of what? Extrapolation. But there is nothing wrong with the calculation. Class, are we good? Are we
Yes, we are
good?
good.
Okay. Now, in this case now, okay, thank you. Now, in this Gordon's growth model, right, it
Yes.
makes use of accounting profits, right? It makes use of accounting profits, right? And what is the formula? The formula is R times B, right? Now, what is G? The G is the growth in future dividend. The G is the growth in future what? In future dividends, right? While the R is what? The accounting rate of return or the return on investment. The R is the return on investment. G is the growth in the future, which you are calculating for, right? The R is the accounting rate of it or return on investment. Let's say return on investment, right? Return on what? Investment. While your B is the retention ratio. Now let's quickly talk about the return on investment. Now, return on investment will not be given. Sometimes will not be given to you in the question. You need to determine that because you want to use the Gordon's growth model to determine the growth rates, right? Don't forget what bring about extrapolation as well as Gordon's growth is to calculate the growth rate. That is what bring about the two class. Now, the return on investment will not be given. How will you now calculate the return on investment? It's calculated as profit after tax divided by your capital employed, right? Now, profit after tax divided by capital employed, or okay, then capital employed is calculated as the net assets, right? The net assets, right? Either you say, oh, the capital employed could be net asset, could be total asset, could be total equity. Examiner may define it examiner may not define it. When the examiner did not define the capital employed, you can use total assets, you can use total equity, right? As your what? As your capital what? Employed. Now, why the B, which is the retention? Retention class. Retention means retain any, retain any, retain any. Let me say it again. Retention means retain any. Class, that your profit after tax, right? You have what you need to share for investor, right? You need to, from your profit after tax, you pay your dividend, right? Your profit after tax or your profit for the year minus the dividend, we give you your what? Retained earning. We give you your what? Retained earning. Class, retained earning. So that is why they say B is retention ratio. Then you need to look for the ratio. Now the question is, how will you calculate the retention ratio? It's calculated as what? The profit after tax, don't forget, your retained earning is profit after tax minus, oh, the class will end in 10 minutes. Thank you. Profit after tax minus your dividend divided by the what? The profit after tax. We give you your what? We give you your retention ratio because you want to calculate the ratio. That is why you need to divide it by profit after tax times 100, you get your ratio. So your A times B will give you your what? Your growth rate, right? So before we create another link, let me quickly, you can ask your question, right? You still have like 7 minutes to ask question so that we can create